Now let's just imagine that you have a cousin in Dubai. He works hard, sends money home every few months, keeps some savings in a US dollar account abroad. Now, he's not a billionaire, just a regular guy making decent money in the Gulf. Now one day, his bank in India sends him a message that reads, earn 7.10%, 7.10% interest on your dollar deposit. Zero exchange rate risk, tax-free interest. 7.10% in dollars, when the best savings account in America is giving him maybe 4%. And here's the thing, that offer didn't come because Indian banks suddenly got generous. It came because India needed his dollars. Very bad. And what's happening right now in the Indian banking system tells you something very uncomfortable about the state of the rupee, the state of the economy, and exactly what the RBI is willing to do to protect the rupee, the economy, and the entire country. See, the Indian rupee recently, it settled at around 95 rupees against $1 US. Now, if you're sitting in India and you've been buying anything imported, your phone, petrol, even the vegetable oil in your kitchen that comes from Indonesia, you're quietly been paying for it. The rupee has depreciated 7.04% in calendar year 2026 alone, and not even half of the year has passed, with experts warning that the currency would potentially touch the 100 per dollar mark if the currency depreciates at the current pace of decline. 100 rupees per dollar. This is not just a number. That's actually a psychological and economic wall. It means that every importable India pays, crude oil, electronics, defense equipments, gets that much more expensive. It means inflation pressures that you feel at the grocery store, at the petrol pump, and in your rent. Since the West Asia war began in late February 2026, the rupee has fallen by 5%. The rupee has also been the worst performing currency in Asia, both in 2025 and continuing to be the worst performing currency in Asia in 2026 as well. And when a currency is under this kind of distress, central bank don't just sit and watch, they deploy tools. And some of those tools are very blunt. Biggest one is selling dollars from reserves. But the really interesting tool is the one that involves 35 million overseas Indians scattered across the world, and that's the FCNR B story. And the story that is ancient, surprising, and very much alive right now as well. Now, to understand it properly, let's go back to the year 2013. Yes, 2013. And the character at the center of the story is a man named Vajiram Rajan. Now, he had just been appointed as RBI governor, a University of Chicago economist he is, and the guy who had actually warned about the global financial crisis years before it has actually happened is now appointed as RBI governor. And he walked into one of the worst currencies crisis which is going on in the world in decades. And the rupee had collapsed from 55 rupees per dollar to 69 rupees per dollar in just a matter of months. A crisis very, very worse. Foreign institutional investors, they were pulling money out of India right there, like what they're doing right now. Oil prices were elevated right now, also they are elevated. India's current account deficit was ballooning, and the word crisis wasn't being whispered anymore. It was being said out loud in finance ministries. Vajiram Rajan needed dollars for the country very fast, and he didn't want to just drain India's foreign exchange reserves further, and he needed to pull some fresh foreign currency in the country. And he had a tool that has been sitting in RBI's toolkit for years but hadn't been weaponized at scale, and that tool was FCNR B deposits. So what is an FCNR B deposit? You must know about that. See, the full name is Foreign Currency Non-Resident Bank Deposit. Now, it is essentially a fixed deposit that an NRI can hold in an Indian bank, but in foreign currency. Remember, US dollars, British pounds, euros. These deposits offer a tax-free interest income and full repatriability of the principal and the interest. And the key feature is complete protection against exchange rate fluctuations. That's the most important feature of all. And the money comes in as dollars. It stays in as dollars. It earns interest in dollars, and when the NRI wants it back, they get it in dollars. The rupee going from 85 to 95 rupees doesn't affect them one bit. For a non-resident Indians working in the US or the Gulf, this is a genuinely attractive product. You keep your savings in dollars, you earn interest on them, and you are not betting on the rupee, and India's banking system holds your money. See, you keep your savings in dollars, you earn interest on them, you are not betting on the rupee, and India's banking system holds your money. A win-win if the interest rate is competitive. That's the problem Raghuram Rajan solved in 2013 in a very elegant way. The RBI offered banks a concessional swap window. See, banks could raise fresh dollar deposits from NRIs and then swap those dollars with the RBI at a fixed rate of 3.5% per year. This meant that banks could profitably offer NRIs much higher interest rates because their hedging cost, the cost of converting and protecting against currency moves, was being subsidized by the RBI itself in our country. Now, what was the result? Through RBI's swap window in 2013, banks gathered $25 billion from non-resident Indians through FCNR B deposits. $25 billion. Now, some analysts estimate that the scheme attracted something in the range of $34 billion under that 2013 operation. So, some estimates are of $34 billion as well. And the rupee eventually stabilized. This is what we need to understand. The crisis was averted. Raghuram Rajan became a legend. Now, fast forward to 2026, the RBI played same card exactly again. And here's where it gets more interesting, because if 2013 playbook worked so well, why wasn't it being used all along? So the answer has everything to do with hedging costs. And this is the part most people completely miss when they read headlines about the NRI deposit rates. See, when an Indian bank takes a dollar deposit from an NRI, it has a problem. See, the bank's assets, its loans are in rupees. Its liabilities, the NRI's deposit, is in dollars. If rupee weakens significantly during the deposit period, the banks end up owing more in rupee terms when it has to pay back that dollar deposit. So banks basically hedge this currency risk. They buy protection in the derivatives market, and that hedge has a cost, roughly around 3% per year right now. And based on current hedging costs of around 3%, banks could comfortably offer rates that are 150 to 200 basis points higher than the prevailing levels once the RBI absorbs that cost. See, but without that support, a bank offering 4% on an FCNR B deposit was actually paying closer to 7% in effective cost once you added in the hedging, and that made it unattractive. Banks preferred to borrow from global capital markets where rates were more transparent and the process was simpler. And here's the shocking data point. FCNR B inflows dropped from $7.08 billion in 2025 to $946 million in financial year 2026. Now, this is something very huge. Divergence is very huge. Read that data again. From $7.08 billion to $946 million. That's not a small drop. That's an 87% collapse in a single year. And the NRI dollar pipeline into India through this particular instrument had essentially dried up. And at exact moment the rupee was under severe pressure, at that exact moment India needed those dollars most. Why? Because India's foreign exchange reserves stands at around 691.11 billion as of March 2026. Now, this sounds like a lot, but the RBI has been spending heavily from those reserves to defend the rupee from even sharper fall. Between 2024 to 2025, RBI's gross dollar sales in foreign exchange market jumped to $399 billion, approximately $400 billion. Mostly interventions were there to prevent excessive rupee volatility. Now, you can't keep doing that forever, and you can't keep doing that forever without running down between buffers. And your buffers might come down over a period of time, and then the West Asia crisis hit. After the Iran war started, which is in early 2026, the pace of the rupee's depreciation, it accelerated even further, and it was driven by the surging crude oil prices, foreign institutional investor outflows already discussed with you, and general risk aversion again already discussed. See, the rupee has been breaching record lows, we all know that, and the policy makers are concerned about the possibility of it crossing the psychologically important level of 100 per dollar, and probably in the near future, in the next few months, it might cross this particular volume as well, and it might become 100 rupees $1. Now, this is the context in which the RBI made its move. On June 5th, 2026, the RBI announced authorized dealer banks raising fresh 3 to 5 year FCNR B deposits would be eligible for a facility under which the central banks would bear the full hedging cost until September 30, 2026. And then on June 8, this week, the RBI formally launched the US dollar rupee Forex swap facility for fresh FCNR deposits with the maturity of 3 to 5 years. So the swap window is open until October 16th, 2026 for deposits raised between now and September 30th. But But there's more. The RBI also exempted fresh FCNR-B deposits raised under the scheme from the maintenance of CRR and SLR. See, again, I'll repeat this point because this point is very important. The RBI also exempted the fresh FCNR-B deposits raised under the scheme from maintenance of CRR and SLR also, which means there is no need for maintenance of CRR and SLR with respect to FCNR-B deposits. See, CRR and SLR are the portions of deposits that the banks are normally required to park with the RBI or in the government securities. They are unproductive capital from the bank's perspective, and by exempting these deposits from both, the RBI is essentially giving banks a double incentive. The reduced cost on one side, better capital efficiency on the other, and the effect was immediate. Banks started repricing. Rate hikes between 300 to 350 basis points have been already announced, taking US dollar FCNR-B deposit rates at some banks as much as 7.10%. HDFC Bank and Central Bank of India have set their rates at 6%, while Yes Bank and AU Small Finance Bank are now offering 7.10%. See again, 300 to 350 basis points. That's 3 to 3.5 percentage points of rate increase in a single week. On a dollar-denominated deposit, think about what 7.10% on a dollar account means for a software engineer in California or a nurse in London who's been parking money in a US savings account at 4%. 7.10% would mean humongous deal for them. So India has fired its biggest diplomatic financial weapon so far. The emotional and the economic loyalty of its diaspora and the numbers behind the diaspora are staggering. As of 2024, the global Indian diaspora members, approximately 35.42 million people, consisting of 15.85 million NRIs, 19.57 million people of Indian origin. This is the largest diaspora in the world, and India has historically been one of the largest recipients of remittances globally in 2023. India received around $120 billion in remittances, nearly double than that of Mexico, which received around $66 billion. See, outstanding NRI deposits already in our country are standing at around $165.65 billion. Again, that is humongous. Shows the potential. And whatever I've told you, that's a pool of trust that has been built over decades. See, the FCNR-B component of that, a $33.76 billion, is just one slice. And the question is, will this work? See, there are genuine reasons to be optimistic and genuine reasons for caution. The optimistic case is straightforward. 7.10% in dollars is a genuinely exceptional rate for global standards right now. See, the product is structurally elegant for any NRIs who want to keep their savings in foreign currency, and India's banking system is stable and credible. See, the 2013 precedent is powerful. That time, Raghuram Rajan pulled in something like $34 billion. Even half that number would make a meaningful difference to India's foreign exchange arithmetic. But there are reasons for caution too. The scale of inflow will ultimately depend on whether the interest rates offered are attractive enough compared with other dollar-denominated areas. See, the scale of inflows will ultimately depend on whether the interest rate offered are attractive enough compared with other dollar-denominated assets, including the US Treasury and the overall bank deposits. See, please understand through this an example. An NRI in the US who can earn 4.5% on the US Treasury with zero geopolitical risk will need to be genuinely convinced that the extra 2.5 to 3% points is worth locking money in for 3 to 5 years in Indian banking system in the current environment. There is also the optics of the rupee itself. One senior banking noted that while there are customers who will take this opportunity, particularly when the rupee is 95 something, if the rupee recovers, that would also be their advantage, since they'd earn returns both on the dollar deposit rate and from any rupee appreciation. See, that's the bull case of NRIs who are optimistic about India's macro trajectory. But here's the uncomfortable flip side. An NRI considering this deposit is also making an implicit bet that Indian banking system will remain stable, that the rupee won't completely free fall, and that whatever global crisis precipitated, the scheme won't get significantly worse. These are not trivial point bets. Let's just step back and see this for what it really is. See, India is having roughly 35 million strong diaspora sitting outside the country, holding foreign currency savings. Now, these people have emotional ties to India, their parents, their siblings, their ancestral homes, and every time India faces a dollar shortage, it turns to its diaspora and says, help us, we'll make it worth your while. In 2013, it worked. In the late 1990s, after the Pokhran nuclear test and sanctions, India floated the resurgent Indian bonds and Millennium Indian bonds to raise dollar from NRI and raised billions. See, in 2013 it worked. In the late 1990s, after the Pokhran nuclear test and the sanctions, India floated the Resurgent India bonds and the Millennium India bonds to raise dollars from NRIs and raised billions of dollars. Now there is a long repeating pattern here, but the insight isn't just that India is doing this again. The insight is why India consistently needs to do this and what it says about the structural architecture of Indian economy. See, India runs a current account deficit. It imports more than what it exports. In value terms, it imports crude oil in particular, and oil is priced in dollars. So India is perpetually in a situation where it needs more dollars than it earns through exports alone. See, the gap is filled by foreign investments, remittances, service exports, and in moment of stress. So please understand clearly, India is perpetually in a situation where it needs more dollars than it earns through exports alone. The gap is filled by foreign investments, remittances, service exports, and in moments of stress by those special NRI schemes. See, the RBI bearing the full hedging cost for these deposits. It's not charity, is the cost of running a managed exchange rate in a world where India's structural dollar deficit creates a recurring pressure on our country. See, the RBI is essentially saying that the cost of supporting the scheme is cheaper than the alternative, which is depleting our forex reserves even faster or letting the rupee fall even more sharply. Here's one thing you should remember and tell someone else about the story. See, India's real strategic reserve isn't $691 billion sitting in the RBI's coffers. It is 35 million Indians living abroad who can collectively be mobilized to send dollars home when the rupee is under fire. See, the FCNR scheme is basically India's emergency dollar valve, and right now the RBI has opened that valve wide. But here's the question that you should keep you uncomfortable. See, if India keeps needing to run this playbook in 1998, 2013 and now in 2026, are we solving the problem or are we just managing the symptoms? The underlying reason the rupee is vulnerable, the underlying reason India faces these dollar droughts periodically hasn't changed. See, India still imports over $150 billion of oil a year. India still runs a structural current account deficit. The export base, despite all the talk of Make in India and PLI schemes, hasn't expanded fast enough to close that gap sustainably. Every time India dips into a diaspora savings to stabilize the rupee, it buys time. But bought time is not the same as built capacity. So the question to ask your policymakers and to ask yourself is that when will India be in a position where a currency crisis doesn't require a phone call to 35 million people abroad? Because at some point the diaspora will have other options and the valve won't always open on demand. Because at some point the diaspora will have other options and the valve won't always open on demand. I hope you understood about this particular issue and you gained some new perspective. All the very best and have a beautiful day. Thank you.